Welcome back to Grade 10 Accounting. In this video, we want to look at a question on cost accounting. We're going to look at manufacturing and budgets, and also we're going to look at VAT. So this is the question that we have, and it has got 20 marks. So it's question 7 on that question paper, and 7.1 in particular, and it reads, choose the correct word or amount or percentage in order to complete the sentence below. Only rewrite the correct word and not the complete sentence. So we are just going to write the missing figure, or be it the missing word that is there. So let's just try to see on the first part of our question, which is now 7.1.1. So if you go to 7.1.1, it reads VAT is a or n system of taxation. So go to the responses that you are given there and look for the correct one. Remember, VAT is just an indirect system of taxation. So I remember indirect system of taxation, we can just say indirect taxation. Indirect taxation refers to, you see that it is a tax that is levied upon goods and services before they reach the customer, who ultimately pays the indirect tax. So we are saying it is levied upon goods and services before they reach the customer. So we are going to see that it's not going to be charged directly as compared to pay as you earn as a tax. It's not directly charged to the customer, but it is charged through maybe they are retailers that are going to sell the products. But who is charged the VAT is the customer who is buying the product. But you'd see that SARS is not going to charge the customer directly, but it goes through intermediaries like the retail outlets. So this is what we have. So you see that it is collected by an intermediary such as a retail store. So this is exactly as we are trying to explain it here. So the answer that we have there is that it is an indirect. So we have got indirect here is our correct answer. Then 7.1.2 in South Africa, the standard rate of VAT is we see that from the responses that you are given, you know that the current rate of taxation is 15%, which is the current rate that is being used at the moment. So we are going to put our 15% here. Then 7.1.3, VAT payable on SARS is known as VAT. So if you have got VAT payable that you need to pay to SARS, we call it VAT output. So we have got output as our answer here. Remember, we've got VAT output and VAT input, and you know that when we are in the control account of VAT, whereby we are saying we are going to put our VAT output on the credit side and then our VAT input on the debit side. So basically, that's what we have in terms of sales. So the opposite is true when you go to purchases. When we are now taking into account purchases, it becomes a VAT input. So we go to 7.1.4. Brown bread is an example of an item that is. So you see that the correct answer that we have there is 0 rated. 0 rated, and then we go to the next question, which is now 7.1.5. Items on which VAT is currently not charged are known as items on which VAT is currently not charged are known as exempt items. You know that these ones are called exempt items. So you see that the responses that we are putting there, 0 rated is here, exempt is here. So this is what we have. Then we go to the next one, 7.1.6. VAT that is claimable on purchases is known as, this is the same as we are trying to explain there. This now becomes VAT input. So here we're just indicating input. This we can take it from the point of view when we look at the movement of money. When purchases money is moving out of the business, so it becomes input. On sales, will be receiving money, so it becomes output. So you go to 7.1.7, a business with turnover or sales of dash or more per year should register as a VAT vendor. We know that when it's more than 1 million rand, so basically we are going to write it as 1 million. So this is what we have. So this is the response that we have here. Then 7.1.8, VAT is payable to, we know that it is payable to SARS. This is uh, this is the parastatal that is involved on the collection of tax. So VAT becomes part of our taxation. So it's payable to SAS. So we've got our answer that we have for 7.1.8. Then we can go to the second part of the question. Second part of the question, which is on manufacturing. 7.2 reads match column 8, column B. Only write down this correct letter as your answer. Fixed cost is first one, and we have to match it with the explanation that we have in column B. But what you know about fixed costs is that they do not change with the level of output. Even if you don't produce anything, you produce 0 units, you are still going to pay the same amount of fixed costs as you produce even 100 units. So producing 100 units or producing 0 units, you pay the same amount of fixed costs. They do not change with the level of output. So according to the explanation that we are given there, you would see that if you go to E, costs that remain the same no matter how many units are produced. So we have our E here. Then we've got P, work in progress. So we know that work in progress explains those units that are still in the process of being produced. They are not yet complete, becomes a work in progress. So you see that the answer, according to the response that we are given there, if you go to D, partially completed a product. So it becomes the response that is correct. Factor overhead costs, 7.2.3, you would see that if you go to B, cost incurred in the running of the factory. So we have got our B in the 7.2.3, 7.2.4, direct material costs. Then we look for the explanation that is matching 7.2.4. You see that direct material, these are costs that can be directly linked to the production of a specific product. So if we got a cost that can be directly identified in the production process. So we've got A, and then a variable cost, these are costs that change the level of output. Producing 0 units, you are not going to pay any, it's 0 variable cost because you haven't produced anything. But if you produce 10, the cost will increase, produce 20, they will increase again. So they change with the level of output. So 7.2.5, our response that we have there is F, costs that vary according to production. We've got F here. Then direct labor costs, 7.2.6, you would see that if you go to C, cost of labor of the people who are directly involved in production process. So this is exactly what we mean by cost of labor. So we've got C. Yes, our correct answer. So this is what we have in terms of the second part of the question. Then we've got third part, which is on budget, which is saying read each sentence carefully, indicate by referring to the underlined information whether the statement is true or false. We've got 7.3.1, which is saying a capital budget is focused on fixed assets, which is correct there, which is true. So here we are indicating it as true. So we know that a capital budget, it is the process of allocating resources for major capital or investment, or investment maybe in the form of machinery, or it can come in the form of investment of machinery. So you'd see that the first statement on 7.3.1 really is true. So we go to 7.3.2. A budget is a plan of action of the current period. A budget is not a plan of action. We know that a plan of action is a strategy. So a budget, usually a budget, when we're trying to define a budget, we can define it in a calculation plan, usually on a financial basis. So that's the definition that we have in terms of budget. So we see that this is false. So we are going to have our false here. Then we go to 7.3.3. A cash budget includes bad debts. We know that a cash budget only records the actual movement of cash in and out of the business. That is the plan in terms of the expected cash movements in and out of business. But if you look at bad debts is a non-cash item. There's no cash movements in terms of bad debts. So this becomes our false. It becomes the correct response that we have there. Then 7.3.4, a budget that is prepared from scratch is known as a zero-based budget, which is true. And then 7.3.5, long-term budgets are prepared for a period between 3 to 12 months. This is not a long-term, but a short-term because of the period. Remember, long-term are usually from 3 years to 10 years. They become long-term. So this one is false. And then 7.3.6, a cash budget estimates the cash coming into the business and cash going out of business over a specified period. So you see that this is the right explanation in terms of a cash budget, so it becomes true. So these are the questions that we have on the last part of the special paper, that is on cost accounting. Let's meet again in the next video. Let's subscribe and share. And until we meet again, it's bye for now.